The world's financial map just flipped. China has cut its U.S. Treasury holdings to just $757 billion, the lowest level in 16 years. And it's not alone. From India to Saudi Arabia, BRICS nations are selling off, trading treasuries for gold, and shifting wealth into financial hubs beyond Washington's reach. But in a stunning twist, U.S. allies are doing the opposite. Japan now holds a record-breaking $1.1 trillion. The UK has surged past China with $858 billion. France and Israel are buying at full speed, even as they drown in their own debts and wars. According to Bloomberg, foreign ownership of treasuries has hit an all-time high, $9.1 trillion. Yet Reuters warns, those inflows are tilted toward short-term bets, not long-term trust. America's Lifeline is being propped up by allies already near breaking point. The question is, what happens when they run out of cash? For the fourth month in a row, China has trimmed its U.S. bond holdings. In May 2025, they slipped to $756 billion, the lowest since 2009. A decade ago, Beijing sat on more than $1.3 trillion, the world's largest treasury pile. Now, month after month, it's letting that stash erode. And yet, overall foreign ownership keeps climbing. By mid-2025, foreigners held $9.13 trillion in treasuries, nearly $1 trillion more than last year. America is leaning harder than ever on outside money to refinance its ballooning debt. But the composition of that money is shifting. The big buyers aren't rivals, they're allies. Japan leads the charge, with holdings rising to $147 trillion, a record. The UK has overtaken China for the first time, piling up $858 billion. France added another $70 billion while Israel boosted its stake by 46%. Allies are stepping up, rivals are stepping back. India trimmed $14 billion. Saudi Arabia, despite its surpluses, cut back too. Brazil shifted cash into other assets. And China, the biggest mover, cut more than $57 billion in 2024 alone, rerouting funds through Belgium and Luxembourg to mask the sell-off. Where's the money going? Into gold. China's central bank bought over 15 tons of it in late 2024. Bloomberg reports Beijing has even been shipping bullion out of Western vaults and back into Shanghai and Shenzhen. The strategy is clear. Swap paper debt for hard assets and local currency trade systems. But here's the catch. The allies doing the heavy lifting aren't exactly strong. The UK is paying the highest borrowing costs in 27 years. France's bond yields just climbed above Greece's. Israel's war budget is exploding. And Japan, with record spending on defense and pensions, now faces its highest debt service costs in history. These governments aren't buying treasuries because they're rich. They're buying because Washington needs them to, even if it hurts. But how long can that last? In May 2025, foreign central banks sold nearly $20 billion of long-term treasuries, shifting instead into short-term bills. Investors are saying, we'll park money here, but not for decades, just for months. This wasn't supposed to happen. For decades, the US ran a cycle, trade deficits funded by foreign reinvestment in treasuries. Between 1980 and 2011, more than $8 trillion flowed back automatically into government bonds, a closed loop that powered both US consumption and global growth. Now, that loop is breaking. Dollars earned in BRICS trade don't circle back. They're flowing into gold, local settlements, or new hubs in Hong Kong, Dubai, and Riyadh. China is even lending dollars abroad at cheaper rates than Washington pays. Russia, far from collapsing under sanctions, has built deeper energy trade with Asia. Saudi Arabia still prices oil in dollars, but recycles less of it back into US debt. For America, this is no longer a self-funding system. It's a firefight. The numbers tell the story. Japan added $56 billion in 1 year. The UK added $112 billion. France added $70 billion. Israel added $32 billion. Almost exactly offsetting what China, India, Brazil, and Saudi Arabia sold. Yes, the totals balance. But the identity of the holders has flipped, and that makes the system more fragile. The US now needs over $2 trillion in new borrowing every year through 2028 just to cover rising interest costs. Net interest is set to exceed $1 trillion annually by 2026. Allies can't carry that burden forever. Markets are already signaling stress. 30-year Treasury yields are back near 5%, the highest since the 2008 crisis. UK and Japanese bonds are also hitting multi-decade highs. Investors everywhere are demanding more return to hold government debt. If allies keep buying, they pay a steep price, not just for themselves, but for Washington. And fragility runs deep. France faces snap elections over debt fights. The UK is trapped by record borrowing costs. Japan must juggle military expansion with an aging population. Israel is locked in conflict. Allies have the will to support Washington. What they lack is capacity. Meanwhile, China's sell-off isn't panic. It's deliberate. Step by step, it's insulating itself. Building gold reserves, hiding some treasuries through custodians, shifting into short-term bills. Enough US assets to avoid confrontation, but never enough to stay exposed. Even equity flows tell a split story. In May 2025, foreigners poured $114 billion into US stocks, the biggest inflow in months. Confidence in Wall Street? Strong. Confidence in Washington's debt? Weak. The IMF says the dollar's share of global reserves has fallen to 58%, down from 70% 2 decades ago. Gold's share, meanwhile, is at its highest since the 1970s. This isn't sudden de-dollarization. It's a slow, steady rebalancing. By late summer 2025, America's reality is clear. Debt auctions still find buyers, but only because allies and private investors step in. Rivals are carefully pulling back. Allies are stretched thin, and the US must refinance trillions at ever higher yields. The Treasury market is stable, for now, but it's balanced on a knife's edge. Hedge funds smell the fragility. CFTC data shows record bets on Treasury volatility. Open interest in futures is the highest since 2008. Short-term bills now make up 2/3 of foreign purchases, up sharply from just a few years ago. Sovereign wealth funds are diversifying too. Norway's giant fund has cut dollar bonds to below 30% of its portfolio, shifting into equities and non-dollar assets. Even allies are hedging. Credit default swaps on US Treasuries have quietly doubled since early 2024. Thinly traded, but a warning sign of rising fiscal risk. And yet, the US remains the least imperfect option. Eurozone debt is splintered. Japan yields too little. China carries political risk. That's why demand for treasuries still exists. Not because of faith, but because there's no better alternative. That's a fragile foundation for the world's largest borrower. Because if rivals won't recycle America's deficits, and allies already at their limit are the only ones stepping in, what happens the day those allies simply can't anymore? That's the Geoscope cut. Do you want me to also trim this into a shorter, 2 to 3 minute script version for faster YouTube delivery? Or keep it in this long-form detailed narration style?